Real estate is being reimagined at unprecedented scale. New cities, massive retrofits, and infrastructure overhauls worldwide. The capital needed is staggering. Trillions of dollars over decade-long timeframes. Traditional finance wasn't built for this moment. This session examines the innovative funding models, partnership structures, and patient capital sources making this global transformation possible. From building entire cities to retrofitting existing infrastructure for a tech-enabled future. And whether yesterday's investment playbook is obsolete, this is Money Reimagined, New Capital for New Real Estate. Please welcome Jim Garman, Neil Matt, Robert Lair, Brian Mayer, Cale Guthrie-Weissman, and Natalia Karineva.
Hello, everyone. My name is Cale Weissman. I am the New York managing editor of The Real Deal. I'm really excited to be moderating this next panel. We have a really great group, diverse perspectives. We've been talking all day. This has been a really fun event to attend as someone who covers commercial real estate. And it's been the big ideas, how people go about it. I think it was Joe earlier said that often capital markets are reticent to invest in new things that have a long tail because they want short-term gains. And in this session, we're answering that question of like, how does finance, how does capital play into all of these bigger ideas, especially as real estate companies grow, there are bigger expansion goals, all of that. And we have people from all sides of it, from the portfolio side, from the banking side, from the new technology side, from the entrepreneurial development side, and from the advertising side, just talking about the finance side of things. And so I'm really excited to be here with all of you guys. I thought maybe we could just go down, introduce who you are, what your role is, but then also just talk about sort of how the finance and capital aspects have evolved over the last 5 to 10 years in your specific role and what you're thinking about with those changes. Do you want to start?
Sure. Brian Mayer from Wells Fargo. Nice to see everybody. I've been a career investment banker for, I guess, a little over 4 decades, and somewhat uniquely have spent time in different sectors. 2 of those have been real estate and technology. So I spent a lot of time bringing the 2 together, and that's why I'm here and have the relationship with HQO and some other companies like it. So a lot of the things like what was talked about is thinking about how the 2 industries merge, because technology is everywhere, but real estate has been a little resistant given some of the comments made and as to why. And one of the things we're definitely seeing, which is no surprise, and we'll talk about a little more, is that scale matters. And scale matters if you're going to roll out technology. And one of the challenges of real estate is real estate wasn't developed, particularly office buildings, to scale, because they're individualized. Each one is different. Each one has a different age, infrastructure, HVAC system, tenant roster, negotiations, landlords that have different policies. And when most of the office stock that exists wasn't built with the idea of smart buildings, whatever that means. So thinking about how that transition happens so that those buildings can take advantage of scale is something we spend a lot of time on, and some of the comments I think we'll talk about today as to what's going on in the capital markets. And probably the best way to frame the point is we're all probably have heard maybe 1 million times that you can buy the S&P 500 and you're really buying 7 stocks. But that phenomenon of the growth being concentrated, the scaled players have tremendous advantage, and that's showing itself. That works throughout the whole ecosystem, including in real estate. So, I think that's hopefully something we'll cover in our conversations today.
Absolutely. All right, you want to go, Neil?
My name is Neil Mant. I'm not in real estate. I'm an observer and a helper for those people in real estate. So my background is in Hollywood. I've produced movies for Disney, A24. I've created several dozen TV shows that have yielded thousands of episodes. I've won 5 Emmys. I produced the Golden Globe Awards and first to produce the Super Bowl in VR. And 10 years ago, I saw the game Pokemon Go, and I looked at that, I said, that is a global criminal enterprise. It's funny, except it shows up in people's real estate. They require physical real estate to make $7 billion. And if you showed up tomorrow and I was shooting a movie on your property, you'd have some things to say. Like, hey, why didn't you call me? Why didn't you give me an insurance certificate? Why didn't you pay me? Why did you invite 5,000 people to show up here in the middle of the night? And so what I've identified is a new property right. Air rights, mineral rights, land rights, and now digital rights. And so Pokemon Go was the one that got my attention first, but now we've started to see brands and social media platforms put advertisements augmentedly in the digital sphere on buildings. And Netflix just unrolled a giant augmented reality condom on a structure in Argentina. This is getting to be really crazy. And from my opinion, the greatest theft in the history of real estate was Google and Apple Maps. They take all that data, you're not getting paid, it's over, you can't get it back. But you're talking about now, remember the scene from Back to the Future 2 when the shark's coming off the building? That's a lawsuit. Marty's gonna get run over by a car. And of course the movie studio will be sued that made it. The movie theater, who's your tenant, will get sued, and then the building owner who may not even be aware that the tenant is augmenting 150 feet in the street. So what does that mean for lease languages? What does it mean for licensing? You're missing out a lot of money, there's a lot of opportunity, and we are moving from the phone to augmented reality wearables in the next few years. Everybody here has a wearable. Did you know that? Who owns earbuds? Those are augmenting your hearing. That's an augmented reality wearable. And so earlier today I hear everyone talking about experiences. I go into a place. You know what everyone has in common here other than breathing oxygen? 4.9 hours looking at a phone. Which real estate company here has a mobile phone content plan? There's so many things that could be happening, and I'm going to talk about today. Thank you.
All right.
Hi, my name is Natalia. I'm the founder of a company, Silicon Valley-based company, Propi. I'm a former real estate developer. At the current company, we were able to attract very unusual financing opportunity through a token sale in 2017. But even being a real estate developer, also we were quite innovative how to get financing for our construction. And recently, we're doing a roll-up of title companies in order for our company to grow in the transaction automation space. And again, we're using quite a novel model going after venture debt versus banks. So I'm happy to share all those examples of how we find new capital for real estate technology, and share some experiences.
Great, hi everybody. I'm Jim Garman from Goldman Sachs. I'm global head of real estate in our asset management platform. At Goldman Sachs Asset Management, we run about $3.5 trillion of assets. Within that, about $500 billion of alternatives, and then I run the real estate piece of that, which is today about $50 billion of assets. We invest all around the world. We invest across credit and equity in pretty much every sector of the real estate market. Great to be here at MIT. I'm a Brit, but my son is here as a sophomore. He's studying rockets and nuclear engineering. He's got no interest in real estate yet, but we'll get him there. Look, I think to the question, what's changed in finance over the past few years, to me, and it's very relevant for real estate, is the explosion of private markets and the explosion of private capital, which has kind of doubled from about $8 trillion to 7 to 8 to about 14 today, and it's probably going to double again over the next 5 years. But the big theme in that is the growth in the wealth and retail channels and individual retirement plans. And so I think that will change the way that real estate will get funded over time. So I'm sure we'll hit that topic today.
Absolutely.
Yeah, Rob Lair, founding managing partner of the fund at Hula, doing exactly what Jim just said. We invest in private equity and in venture, but it's place-based. We are from Vermont, Burlington, Vermont, and we're essentially building a quantum city up there, but we backed into it. We wanted to grow jobs and the Vermont economy, so we're not just like a ski town, kind of backwater place where nothing actually gets innovated. And 3 partners got together and said, let's back a bunch of companies as the way to spearhead that development. We did that. We were kind of overly successful to the point where CEOs of our companies were calling us, say we're growing exponentially, but have no place to live, no place to have childcare, and not enough schooling. Our company's, small for the country, but $10 billion in valuation, thousands of new employees, and so we backed into having to be real estate developers, basically to build a quantum city around technology investment, and that's what we're doing right now. We're 8 years in. We've got $1 billion, project that's going into the ground next summer for residential, et cetera, et cetera.
That's crazy. So I thought we could format the conversation sort of starting, looking a little bit back, getting into the present, and then do some more forward thinking that sort of zooms out. And Jim, during the prep call, you mentioned something interesting, which was talking about sort of the shift in how you look the portfolio, sort of the food groups of portfolio. Yeah. Can you talk a little bit about that? Because I thought that that's a great way to sort of start the conversation in terms of how we're thinking about things.
So this is something we're trying to innovate on and embed in our, when we think about constructing funds for our clients, which is that traditionally people have thought about portfolio construction around either by geography, so the different regions of the world, or by the classic food groups in real estate. So people might talk about constructing allocations to residential, to commercial, to office, to industrial, to data centers. We're trying to come at a slightly different way, which is to rather than start with a sector allocation, start with the big thematics that you want to be backing. And by the way, you can apply this to private equity and to credit as well as to real estate as well, which is, and certainly our view, the three big mega trends that are driving the future of real estate, which we've talked about today, is technology, demographics, and then sustainability, particularly in Europe. So if you start from the premise that we want to build a fund around those three big themes, you can determine what your allocation policy is, but then the way to, then you get into how do I express those themes through the real estate I invest in. So if you want technology exposure, you'd obviously be investing in data centers, you'd be investing in supply chain economics around e-commerce driven by technology. Listening to Travis earlier, cloud kitchens, the real estate that's going to house autonomous vehicles and their charging. All these parts of the real estate market which are being impacted by technology, you can express that through those. And then demographics is obviously all about the different types of housing. And then sustainability, you obviously want to be investing in the tip of the spear, lead platinum assets, which are going to outperform the rest of the market in terms of sustainability. So that's a theme we're working on. I wouldn't say we have buy-in yet from most clients still think about the world in a classic allocation way. We're trying to move it to that more sort of thematic.
Yeah, that was my follow-up. Is it how do clients respond to that?
They love it. They love the idea, but when they go back to their investment committee, they shift it back into the classic food groups because that's what they used to. But I think it'll change. And what's interesting certainly for us, and I'm in a business where I run a real estate business, but I have colleagues in private equity, growth equity, infrastructure, private credit. They're all doing similar things. They're just expressing them through their asset class rather than through real estate. And so if as an investing client, if you look at the whole map of private markets, you can really, if you kind of did a look through of your portfolio and said, how am I allocated to those big things, technology or demographics, you can start to see some patterns there. And so I think eventually the whole investment sort of CIO world will start to think more about thematics than just specific allocations.
Got it. Brian, you mentioned the scale part. I feel like that fits into looking at it more holistically. Can you just talk a little bit more about what you mean that it's all going towards scale? Does that mean you can't be successful as a $50 million developer anymore?
It's harder.
Yeah.
And I think it's the way technology's developed. If you just go with the food groups and you compare, for example, data centers to office, the quantum of data centers being built is just hard to quantify. It's just so big. But the bottom line is they are only built because, in a way, they're built because the tenants demand the compute power that they need, and this demand to make it better and better, more efficient will continue. And there are trillions of dollars going into that. If you look on the other hand with office, most of which, as Travis mentioned earlier, is in place. And if anything, we probably have we do have too much of it in the States. Each building was developed at a different time, typically without technology in mind. It was really done on an individual building basis to whatever you needed to do to attract a tenant and get financing, and it got built. And there was a lack of connectivity between the development of the building and the tenant's needs once they're there. And that's really been a problem if you just have one building, because if you want to invest in your building to fix that, it's very inefficient and very cost prohibitive. If you have 20 buildings and you create a software system and you put in the infrastructure, you can spread that cost over a larger number. So in all the food groups, and there's a degree issue, but if you look at hotels, if you look at retail, if you look at data centers, if you look at industrial, there's much more connectivity between what the tenant demands and what the building's offered, because that's just how those individual food groups develop. Office is pretty much, once a tenant signs a lease, you're done. And then you just try to get another tenant if you lose it. So it's been quite hard. And to spend the money, besides software, HVAC and other systems, it's hard to justify that on a single property, which is why if you look at where a lot of the real estate owners represented here, a lot of the ones that have worked with HQO, they're the bigger players. They're the Heinzes of the world, they're the Vernados, they're the Relateds, where they can take whatever costs they need to be state-of-the-art, and they prioritize being state-of-the-art, but spread it over a bigger base. So what we see is that scale is an enormous advantage with creating and moving real estate into a technology platform that's going to be driven by tenant demand. And that's happening methodically, slowly, but given the building stock, it's going to continue to be that way. But in our view, at least, it's going to be led by the larger property owners.
So we're seeing a lot of office distress. We're talking about office. And so are you saying, and we've talked earlier about the move towards experience and catering to tenants. It seems like those two converge here where we're talking, right? Like if you're a landlord, you need to have scale, but you also need to be have a system that's catering to all the needs that will then have economies of scale that will work better than just with one building. Is that right?
That's right. That's right. And it's sticky and slow, because if you think of a typical office lease for big tenant, it's 10 years. So there's not the incentives. If you had a lease that was renewed every year, the tenant could decide, well, if you don't update the building or if you don't provide this, then I'm going to leave. So what happens is there's this very sticky, slow process that the economic motivation isn't there, because the risk of the economics doesn't lie with the landlord, it lies with the tenants, at least for the term of that lease. So as those things are working through, and tenants are getting more sophisticated, and not all tenants are sophisticated. Certainly some of the bigger ones are getting there, and they're demanding these things. So it is happening, but it's just a slow process.
Were you about to say something?
Yeah, I was going to just add to what Brian's saying. I think this whole concept of delivering a sort of an enhanced, superior experience to your customer or your tenant, I think it's something we've found in our investing business. It's relatively easier, it's not easy, but easier to implement in asset classes where you're facing an individual consumer. So whether it's student housing or seniors housing or multifamily, where scale really matters. I mean, it costs money to deliver experience, and so you need the scale and you need the technology. You need a management team that's really empowered with great technology and customer focus. Then you can do it. It's much harder in office, where you've got a very, very sort of transactional customer in a building, I think.
So then, also stop soon, but question for both of you or anyone who wants to chip in, why is prop tech so hard, and why has there not, like, it seems like there have been a lot of companies that have tried to do this, and yet we've one here that's doing pretty well on the CRM side, but like I feel like as an industry it's not been doing great.
We don't touch it. To be honest, I hate to say that, there's a lot of prop tech people here, but COVID took the wind right out of the sails. It's starting to come back now a little bit, but as an asset class for venture and private equity, very difficult.
Then I wanted to lead to you next. Can you just give you gave a history during your intro about what you're doing, but can you just talk about how you went you sort of, as you said, backed into the development space and taking this from the developer side, as we're hearing more from the finance side. How did that come along?
We wanted to create jobs in a state that we love. Our kids were born there. We wanted our kids to be able to have interesting technology jobs, and there just weren't jobs there. So we, our family office, we galvanized 100 other investors, 10 other family offices in the state, and said we together have the capital that we can change the economics of an entire state, and we did that. We mobilized, it's not, again, not a lot of money, we're a small state, but we did $400 million in our group, attracted another $2 to $3 billion, created about $10 billion of market cap in 5 or 6 years, 3,000 employees, and for all the developers out there, follow the money on the private equity and the venture side, right? If you're looking to fill up buildings, talk to the venture people who are funding the upcoming companies, and that's now why we're in the real estate business. We've got 3,000, 4,000 people that don't have homes, and we've got probably almost 2 million square feet of commercial space that has not been built, and we know the companies better than anybody, right? And now we're galvanizing all the real estate around those companies. So it's a chicken and the egg type thing, and we're doing both now. That's why we kind of backed into it. We're primarily, we invest in companies, but for those companies to thrive, they have to have housing, they have to have childcare, they have to have great commercial space. No better to build the commercial space, in a way, than all the private equity investors that gathered resources together to sponsor the companies. So it becomes a virtuous circle, and we think it's a model, frankly, we could export to tier 2 and tier 3 cities that have the similar issues of wanting to stimulate economic growth. Well, it starts by creating the economic engine, the flywheel, and that's what we've done.
That's what I wanted to ask, is
Yeah.
sort of you bring that to other cities.
Yeah.
Are you doing that now? How are you doing that? And let's talk about
Dominic Endicott with knowledge towns and all that, that's the template. We're looking at Manchester, New Hampshire, we're looking at Portland, Maine, Asheville, North Carolina. It's the same flywheel. You organize the capital in the area, you galvanize it, you have to start your real estate earlier than we started it so that you can keep up with the economic growth.
Got it.
I slightly disagree, Rob,
Yeah.
about the prop tech slow
Yeah, no
uptake. Yeah, thank you. I think suddenly we're seeing this industry to wake up in the past couple months. Is anyone here a prop tech founder by chance, or in a prop tech company? Yeah, so you're probably noticing that there is all these conversations about open door revitalizing, about housing affordability becoming a part of the discussion with the current administration, because our current administration has been into real estate. So they will keep this dialogue about the necessity of building more, bringing technology, bringing innovation to the industry, and thus all the VCs are having this now urgence to look at prop tech companies. And the other motive in the prop tech industry is finally the interest to hardware is also waking up. And in real estate, it's very important to pay attention to IoT devices, to innovation in all those robots, AI-driven devices. That is the essence of real estate industry. So I think we're seeing more and more interest in prop tech because of the AI, robotics, as well as the appetite from the administration to address the housing affordability from different angles. It's the transaction automation, that's what we're talking about. 10% of home value is lost today into transaction fees. So Americans willing to buy a home, they hardly can save 5–10% for the down payment, and yet those 10% are spent on title insurance, fees, and the transaction is so complicated. Like Travis said, it's much easier and faster to build in other countries. It's still secure, right? In other countries, we don't see buildings falling down, but the transaction cost is 0.5% or 1%. In America, it's 10%. So we're losing this part of the affordability, and the other part is obviously building and construction. So how can we bring the labor down, how we can allow for more construction to happen, to address the housing shortage. So I think that we have this hope. I don't know if you feel that, but I am observing that there's more demand for prop tech, and hopefully more founders will be funded in the next.
Well, can you talk from your perspective with Proppy, just like how have the tides changed over the last few years, and especially like how are you seeing, what are you seeing in terms of on the investment side, people interested in talking with you, and on the overall adoption side? Because I feel like that's often the question where you have something that is more efficient, but getting people to interested in it,
Yeah, so I think we have we had quite an unusual way of funding our business in the past 7-8 years as a tech company. Even though we were established in Silicon Valley, yes, we attracted Tim Draper as an investor with about $5 million coming from VCs, but the majority of our operations have been funded through a very unusual path. One of them is tokenizing our operations and launching a token, a very compliant utility token, which is listed on Coinbase. It's a $15 million raise in 2017. Now we're applying this knowledge to tokenize real estate assets for our real estate developers. And the majority of real estate developers are approaching us because of all these new laws in digital asset economies, such as Stablecoin Act, all those Bitcoin ETFs that have been approved last year. So finally, digital asset becomes legitimate and legal, and it's a huge opportunity for real estate developers to fund their construction through Gen Z channels, through all this new younger generation that love investing quickly in digital assets. But they also, I don't know if you know the statistics, but the preference of new generation in terms of investments, first is cryptocurrency, but guess what's the second one?
Gold.
Gold is for millennials.
Yeah.
Gold is number second after stock. Gold is for millennials. What is the number two? It's real estate.
No?
The young generation loves those two assets.
I think you're onto something there. I think there's a massive growth in kind of retirement savings going into, the overall world of sort of assets. Retirement savings is growing at I think it's like 9% a year. More and more of it's going to private assets, but there's going to be massive wealth transfer from the baby boomer generation to the Gen Z and the millennials, and I always get the order wrong, but and as that happens, I think more and more of that cohort of people who've grown up with these technologies, particularly the very the people coming out of college now are going to be so kind of AI native. It's going to be normal for them. I think you'll see a sort of a shift in thinking around it. I mean, a lot of real estate is run by people who are not familiar with these technologies, and so including myself, and so the sort of the resistance to change is high. But I think over time, as you get this wealth transfer, it could change.
Yeah, I wanted to ask just Brian and Jim, like given that you're from more traditional finance backgrounds, tokenization. What are your thoughts on tokenization in real estate?
Do you want me to? I mean, you can start. I think and by that, I'm armed with a dangerously small amount of knowledge here, so I'll go as far as I can. And you should take over. Yeah, to me, the logic of being able to put real estate title onto a blockchain platform where the efficiency of transactions should be way, way better than it currently is, that makes sense. The use of smart contracts to transact real estate makes sense. I think the two challenges, the adoption at the moment is low, but it's growing. But I think the challenges are around regulation. I think a lot of people want more regulation to make sure that it's really is what they're told it is. And then if you add cryptocurrencies into it, people transacting. Crypto is too volatile right now. But if you could imagine, I could imagine a world 10 or 20 years from now where huge swathes of the real estate market have moved onto the blockchain and people transact in crypto because it's all become normalized and stable. And I think particularly, this is maybe a controversial comment, but I think with the amount of kind of political volatility in the world, people might prefer to have their asset recognized on the blockchain rather than in some government title register somewhere which we can't access because the government's shut. I mean, there's a lot of reasons why it could work one day. I think it's early, but I could see that happening.
Yeah, I was going to say almost the same things. People forget how, at least in this country, most countries, but just take the U.S., everybody's comfortable. They've learned up to $250,000 to put things in the bank because there's an FDIC and there's a system that protects, and it's worked and it's been stressed. And so we're a long ways to getting to there, and that goes to the regulatory, because what ends up happening is that risk transfers onto the banks, for example, in that case, and they kind of self-insure through the FDIC and have created an organization. So we have to have those types of things that get out to it just commonplace, and I think we are away. So I think regulation is a big chance, but it's going there. It's just a question of how it goes there and what missteps along the way and who's going to take the risk in the system when something goes wrong. Those things will get sorted out, but particularly when you introduce a consumer on the other end, the amount of protections that are in place for consumers in all different agencies and all different types of things creates, I guess, one of the points Travis made, the litigation society. So people are going to have to get comfortable to do that in scale, but I don't know how to measure the timeframes because everything seems to be going faster now, but it feels like we're a bit away from that, but it's going in that direction.
Got it.
Can I add something? Just to clarify, well, first of all, Jim, what you just said, that makes sense. Putting title on chain, using smart contracts, that's exactly what my company is doing. And we're growing through a private credit facility, venture-backed debt. We're getting $100 million venture debt in order to acquire those title companies in every market and then allow them to use our technology, smart contracts and AI, and grow faster nationally. So again, it's an alternative way of using financing versus venture capital. But the reason I'm mentioning it is because recording on blockchain and using smart contracts, it's legal in the majority of our states. So that's not the issue. We don't need any extra regulation to use smart contracts for settlement in real estate, and we're growing very fast. Now, on fractional ownership, which is still not our focus, but we have a lot of real estate developer demand. How many folks here are from real estate developers or represent real estate developers? I would assume maybe 30%, because I talked to a number of people here. So the clarification here on regulation is that when we do fractional ownership tokenization for developers, it's a securitization of a building. So we have to file together with the developer under Reg A, Reg D, so it's a security. And that is absolutely legal. It's straightforward. We need to sell those securities to KYC and AML clients. And then because we have all this new legislation for digital assets on how we treat those transfers, how we do transfers of Bitcoin quickly at the moment so we don't have issues with volatility, for me as a builder of this technology, it's quite straightforward and quite regulated already. Now what I'm hearing, that's probably very interesting for real estate developers in the room, what I'm hearing is that the current SEC administration, and by the way, one of our advisors is a former SEC commissioner. So we take compliance very seriously. But what I'm hearing from SEC and administration is that there is a possibility that fractional ownership tokenization for real estate will be reviewed under different conditions. So we'll have a simpler way to tokenize buildings, which is super promising, because then you get all this Gen Z and young generation to invest in your buildings, have skin in the game, and revitalize the whole community in the building.
Got it. Neil, I wanted to bring you into this. So like, can you talk, we've been talking about different sort of alternative ways of working with developers, working with buildings. I feel like you working with digital rights.
Yeah.
Can you just talk about like how that started,
Yeah.
where it is now, and how you think that fits into the overall piece of the puzzle if you're a developer or in that space.
Okay, while I'm talking, Brian, I want you to think about what's your prettiest, sexiest building, and same thing for your gym. I'm gonna come back to you. Your prettiest, sexiest building. If you had to put one on a brochure that's like this, just think about it. I'm gonna come back to you.
Right away.
You know right away?
Yeah.
What is it?
It's the Bruno Cucinelli store on Saint-Honoré in Paris.
Okay, and is it a whole building or just store?
It's the whole building.
Okay,
It's not
and
big.
you got one off, you gotta think about it.
Think about it.
Okay, you think about it.
Well, it's not the building, it's the suits inside that are beautiful.
No, all right, okay, let's talk about a
Are you
building.
wearing them?
I'm not.
So,
I wish.
so look, I'm here to talk about money. How do you make money? But Jim and others have said that you're fearful or you're slow to adopt the technology. That's for sure. I've been working on what I'm working on for 10 years, and people still fight me on it. But let's talk about the human experience. Okay, that's what I want you to understand. Imagine if I'm sitting here, and it's 1994, and I'm explaining to you the internet. And I'm saying, look, you got to get your domain name. And you're like, I don't want to know about that, okay? And then it's 2005, and we're a year and change before the iPhone comes out, and I can somehow explain the App Store to you. And I'm like, you should pay attention. It's going to be important. I don't need to know about that. But then I say social media is a thing. Like, I don't need to know about that. Well, now you got a team of social media people, right? You got somebody who cares about the internet. You're aware of this. These are things, okay? The internet is shifting. There's going to be a third shift to the internet, and it has already begun. And we're moving from a two-dimensional internet into a three-dimensional internet. It's called the spatial web. Meta alone has spent $100 billion moving towards making eyewear, wearables, VR goggles. I know you don't like VR goggles, just put them to the side. They're making AR glasses, and that's happening. So we have to think about this property right. Okay, you don't have to wear glasses. You can be like, I don't like glasses. Forget about it, okay? That's fine. I'm not making you wear glasses. I'm just telling you there is inherent value in your buildings and in your property and your land that you could extract right now to pay for these other things that you want to do. And whether you believe in them or not, others will. So here's an example, okay? I'm selling a building to you, Brian, okay? We agree that this is a $10 million building, and at the very end of the sale, just before we sign, I say, by the way, I'm going to retain the digital rights. And you say, what is that? And I say, well, you'll be able to license the building for digital advertisement in a few years. If Mark Zuckerberg gets his way, it'll be somewhere between 18 months and max 4 years from now. The whole world is going to change significantly, the human experience. We're going to see three-dimensional information. If everybody here was looking at the Prudential Center right now and we all had Instagram activated on these future glasses, we would all see a different ad on the building, meaning it's infinitely licensable. And that ad could talk to you, meaning it come off the building. And now, where's the insurance that protects the building owner from any media? And so the human experience is going to change, period. Just like it changed if I told you guys 25 years ago that you're going to be like this all day, you would have said I was crazy. But the reality is that's what's happening. We spend 9 to 12 hours a day in front of some type of a screen. Well, it's going to change, and there's going to be amazing experiences. So I'll put on my glasses, and I'll activate LinkedIn, and everybody's LinkedIn profile will have it right next to your face, and that would be incredibly powerful for me. If I'm dating somebody, I could put on a little dating app, and I could tell what you're thinking. There'd be some kind of AI accuracy that can tell what I'm thinking right now, and these tools are being used. I want to hang a painting on the wall. I know I'm going to hit a pipe, so I pull up the CAD drawings from the city, and I can see where the pipes are, and I put it. So there'll be all these utilities that are happening, whether we like it or not. And the fact of it is that people are engaging with media. You talk about Gen Z wanting to be involved in investing in buildings. Gen Z are crack addicts with media. Okay, you ever just take an iPad away from a kid, they go crazy. So the question is, first, how do we as property owners, and I do own commercial real estate and I do own residential real estate, how does a property owner protect themselves from these violations? The first thing is raising your hand and saying, I'm aware of it. So when I sell you this thing, I'm going to keep these rights. And you're going to say, no way, Neil, right?
Right.
And I'm going to say, Brian, we never discussed this. It never came up in conversation because you didn't know about digital rights. But I'm going to tell you about it. And then it sounds like you're assigning value to this, right? It sounds that way when you say no way. Well, we're going to look at that 10 million. We got that number because of real estate metrics, tenant and things like this. So it sounds like you put a value on that. Let's figure out what it's worth, and you can write me a check now. You cannot do that if you don't know about this. So if you're selling a property, you want to retain these rights. If you're buying them, you want to make sure you get it. They are tradable. If I'm building a football stadium right now, Brian and I are going to build a stadium. Sound good?
Right?
It's going to be built in 3 years. Okay? We don't need to wait 3 years to go to a sponsor and sell the naming rights because they know it's going to be there, right? So can we sell the digital rights to a building now in any category? Yes, you can. And so the technical platform that we have built does that. And so a property owner, first of all, it's free. There's no investment, there's no cost. This is completely green in every way. So you'd register your ownership. It's recorded on blockchain. It says, I am the owner of these digital rights. And then a licensee could come in and say, oh, well, I want to use it. And the insurance company sits there, can sell a micro policy per person, and then government can say, oh, we don't allow media on this building. So we can do deals right now that can extract significant cash. So you got your building in Paris, right? You got your building in your head. Yep. Whatever your best building is that you guys have access to, we put that on the system. We're going to do this in the spring. And right now we have over $50 billion worth of real estate. We're going to have $200 billion by the end of December. And pretty much all of our property owners want to do this. So we take that building in Paris, we put it on the system, and we say to the universe, investors of any age, Gen Z, older people, people old as me, whatever, we say, we're going to take 10% of this future, maybe someday revenue, and we're going to sell it right now at auction. Whatever money you get, Jim, it's found money. And all you have promised is that in this future, and by the way, we do that on a fixed term, 2030 to 2035. It's far enough away that it seems possible. I mean, 2035 is 10 years from now. And so there's plenty of people, anyone who bought a virtual land, anyone who bought an NFT, anyone who bought a piece of crypto, any of those people for sure are buyers. And what you've promised them is that in that window, if you make any money, the 10% will go to those investors. But if the industry didn't mature, or you just wake up and you're like, you know what, we're just not going to do any license deals, that money is in your pocket. And then in another 5 years, you sell it again. Or maybe in the middle of it, you'll say, all right, let's pull another 10%. This is money you pull from the future right now. What did that do? Well, it gave you the capital you needed, which is great. You didn't give up any ownership in anything. People talk about selling an asset. You're not selling anything. You just brought in a revenue partner. They have no creative interest. They can't make you do anything. They can't say, put it out of the building. They simply are a passive revenue partner. Does it sound good? Right? Tell me the flaw. And so as a business, we've created this technical infrastructure that allows for this. There's smart contracts in it. So let's say you buy one of my shares and you get cold feet. You're like, ooh, I want to sell this. Or you're like, wow, no one was paying attention. You can resell it because there's a secondary auction in there, right? And then somebody else buys that. Smart contract kicks a royalty, goes back to the property owner. And then someone else buys, so you know what, I'm going to buy it, and I sell it, and just you have this royalty system. And then if they start making money, that'll make that move. So what we're doing now is we're going to seed the industry. Because as I said, the glasses aren't going to come for a couple of years, but there is mobile phone content. So Brian, you guys think about this. Who wants this? You ready? So here's the offer to anybody in this room. In the spring, I'm going to put on a concert. It's going to be at 100 locations. If anyone would like to be one of the locations, just come and talk to me. You may have one, you may have one. Maybe we do something you do. And here's what's going to happen. It's going to be Taylor Swift. It's going to be Harry Styles. It's going to be Beyonce. It's going to be massive. U2, only the biggest of the biggest. And I have those relationships in Hollywood. My partner is a guy named Irving Azoff, and we're working on the talent. He was the CEO and chairman of Live Nation and Ticketmaster. There isn't anybody that we can't get to. And so at these 100 locations, on top of your building, on top of the Salesforce Tower, on top of the Tokyo Tower, whatever, we would do a partnership with Snapchat as an example, or Google, or Instagram, or Amazon. Someone who has audience. I'm not going to tell someone to download my app. That's not what you want to do. You want to do license deals with major apps that have audience. And your building in the Salesforce Tower in the 100 locations around the world, I will open my Instagram app and I will point at it. And on top of it, 150 feet tall, is going to be Taylor Swift or somebody else, right? Who would point their phone at that if they could see that from where they are? All hands up, come on. Everybody would point there. And it's a 15-minute concert, right? Data is extracted because they pointed their phone. The building owner gets paid for every single person that looks at it. Found money. People will take pictures of your building. They'll screen record it. It'll be shared around the internet. Your building will be cool. This is cool. Maybe you own a bunch of malls. Okay, so next year, Christmas time, 2 months, I'm going to produce a giant augmented Christmas tree. There'll be carolers, Santa Claus flying through the mall. It's free to the mall owner. And at noon, 3 and 5 p.m., if I show up at that mall and I point my camera, I'm going to see this amazing show. People will go to the mall to see that show. And of course, all the data is recorded, shared with the property owner. Meta gets paid, advertiser gets their eyeballs, consumer gets an incredible experience, and they go to the mall. And you say, well, no one goes in the back corner of the mall. Put it back there, and people will go there. And so there's an unbelievable amount of licensing that you're going to be able to do with real estate now. In the future, it will go bananas. It will go crazy. And the danger is also insane, too. But we've built the system that does that and allows for transactions to happen right now. And then through my personal relationships in our company, we're going to bring content in 2026, mobile phone-based, and then others will start doing it in a few years. But we can pull capital out of the future for you to spend right now.
All right, well, we're almost running out of time, so that was a great explanation.
Okay.
And there's a tension that I'm overall seeing here, which is that, and there's something you brought up earlier, which is the idea of sort of the retailization, or like that there's a more atomized, sort of individualistic approach as opposed to institutional, but then we have over here that you need something with scale. And so, can you first talk about how the product, what the evolution of the products are in terms of this focus on the layperson, the individual that we talk about, the Gen Z, and then I'd love to hear, do you see that tension at all in terms of how capital is being shifted or markets are being moved in relation to that?
Yeah, I mean, I think the big evolution that's going to happen is the design of investment products for wealthy individuals and then people's individual retirement programs, the 401ks. And I think there's a bit of a conflict because that, unlike the institutional market, which has really grown over the past 2 decades, which is willing to take different types of risk, this next generation of investors, I think, want from their real estate a pretty simple thing, which is income, inflation protection, and diversification. They're not looking for the big swings at the big risky projects. And yet, most of what we've talked about today, including your thing, which I think blows my mind, is they're pretty high-octane, risky propositions. We're talking about building new cities today. We're talking about building billion-dollar data centers one after another. So I think the capital that's going to really grow may not always match the projects and the risk that people want to invest in. So there's a thing there, and I don't know what the answer to it is. I think that the riskier projects will always be the purview of the wealthy private investors and the institutional market. So,
Do you have anything to add?
Brian,
Yeah, I'd just say the history of the world in terms of investments is, while they have worked periodically, there's very few financial products, whether real estate or any investments, that work for retail and individuals that don't work for institutions. And it makes a lot of sense because institutions and wealthy investors have the ability to assess, research, analyze, and protect themselves in a way that individuals don't. So you think about, just take the REIT market, for example. There's like no REIT in the world that's lasted that didn't work for institutions. It's a heavy retail product. It also works for retail. So there is a testing that goes on. And that's one of the things about real estate that should work. So I think there's always going to be a need for institutionalization, and that goes to the regulation and that goes to consumer protections, because some of the things that go on, whether some of these meme stocks and so forth, that lasts for a period of time until someone gets burned and then it stops. So I think they all kind of go together. But I do think one of the things that was said earlier, I think by Jim, is that you still have to satisfy the consumer and the need for real estate in whatever they're doing. And that's why I think the asset classes do differ. And I continue to think the office is the hardest because so much of that stock is built a long time ago and it's expensive and hard to do it. And so I think the scale kind of comes back to the scale that matters. But it's happening and it's going to happen. It's going to continue to happen because the tenants are going to demand it. And I'll just close on one thing, at least from the scale point. If you take the different food groups, and we talked about, annual leases for a residential, for apartment, or 10-year leases for an office building, or 15-year leases for a data center. The thing that has a one-day lease is hotels. And if you look at hotels, the brands have taken over. It's very hard for independents to create 20, 25 hotels, like almost impossible. Because of why? Because the consumer demands the brand, the consistency, the reservation system, the loyalty framework, and that's billions of dollars. And so that industry has been shaped and continues to be shaped by the large-scaled investors being able, and they have implemented technology, and they have spent billions on making those work. And one of the most effective direct-to-consumer marketing campaigns has been loyalty programs for hotel companies. So you see a case where scale really does matter, and I think that will continue to be the case with anything that requires big capital investments and big strategies. And then after it's kind of satisfied, then perhaps on the investment side, there'll be ways to make it available to individuals and retail that have some amount of protection built in by the scale that institutions have kind of created.
Rob, I wanted to ask you, just given that you're at a smaller scale, like you're in Vermont, you want to go to these second-tier cities. What is your approach? Do you ever want to get deep, institutional, or are you just looking for those geographies there? And I think about bigger projects similar to yours, like Saudi Arabia's Giga project. Like, I feel like there are allusions to it. So how would you approach sort of scaling a project like yours?
Yeah, I mean, I think ours is a local approach, right? So 90% of all assets are private, 10% are in the public markets. It's hard to believe, right? We focus on the public markets all the time. It's only 10% of all capital that's moving. We've got people coming to us all the time, again, 100+ investors saying, how did you guys get shares in XYZ company, right? Or can I get a share of, it's almost like a REIT, Blackstone REITs, right? I mean, we're kind of a local version. You could do this in a Portland, Maine, which will be our next place, I think, where you create a REIT with the local investors. It's a local thing, and those local investors really know these markets, and they also lever and help galvanize tenancy and everything else. It's almost no offense, dudes, but it's almost an anti-institutional approach. And we work with Citibank, Goldman, Morgan Stanley. I'm a Morgan Stanley guy. So, but you're galvanizing local energy. We're talking tens of billions of dollars in some places, right? And that really knows these markets and then can work alongside Goldman Sachs, right? So anyway, I don't know if that answers your question, but that's what we can see repeating over and over again in the Portland, Maines, Asheville, North Carolinas, et cetera.
Got it. All right, I wanted to open up. Does anyone in the audience have any questions?
Can I add one more
Of course.
thing if there are no questions? I think you touched on a very important aspect of the need of the local investors' participations as well as the institutional players like James and Brian's and so on. And what I'm observing in the tech industry, this evolvement of a whole new asset class, investors that sit between venture capital and the biggest banks, which is private credit funds investing and providing credit to tech-driven companies. And it's such an important niche. For example, this company, Takora, they raised funds from Peter Thiel, from Andreessen Horowitz, the best, biggest VCs in the category. But now they're going after underwriting businesses that are growing maybe not as fast as venture capital, but companies that normally Goldman Sachs and Wells Fargo would back, but at a later stage. So it's a very interesting new segment evolving with people who understand the institutional underwriting, but also technology, AI-led roll-ups, M&As. So in terms of the new capital, it's just we're overseeing all those new asset class emerging. And again, this balance between the bigger checks and smaller checks and equity rounds or credit rounds, it's very important for our economy.
Yeah. All right. No other questions? I think we can be done. This has been great. Thank you so much, everybody. I really enjoyed this conversation.